Vicky here, and today we are going to talk about hedge accounting. Now, hedge accounting, you must have heard about this term and this technique a lot of times because this is one of the highly tested topics in ICAEW ACA ICAEW exam advanced level. So, we are going to talk about hedge accounting, and I will explain it to you in a very easy to understand manner and see exactly what it is and how it is applied, where is it recorded, things like that. So, first of all, what exactly is hedge accounting? So, hedge accounting is simply a risk management strategy used by companies to reduce exposure to unwanted risks. Okay, so this is the strategy which companies use in order to minimize their risk or manage their risk, in other words, particularly those arising from such as fluctuations in interest rates, exchange rates, or commodity prices. Think about it as an insurance. So a company might be exposed to a risk that the price of commodity they need to buy will increase in the future, or that the value of the foreign currency they will receive will decrease. Hedging allows them to mitigate these risks. As you can see in here, there's a hedging cycle. So you identify the risk, which normally is your hedged item. You implement the hedging technique, which is your hedged instrument. You monitor the effectiveness, and then you adjust the strategy as you go. So this whole process is called hedging. Now, why hedging is important? See, without hedge accounting, hedging is to manage risk, but without hedge accounting, the accounting for the hedging instrument, which is the tool used to hedge the item or risk, such as a derivative, and the hedged item, the item exposed to risk, would be treated separately. So this could lead to a mismatch in the timing of when gains and losses are recognized, potentially distorting the company's financial performance. So hedge accounting aims to align the accounting treatment of the hedged instrument and the hedged item. So what that is going to give you in return, a more accurate picture of the company's risk management activities. If you look at aligning accounting for accurate risk management, without hedge accounting, you will have mismatch. You will have distorted financial performance, which means that you can't rely on that financial information provided to you. But with the hedge accounting, you've got aligned timing, accurate financial performance. Now, these are the key concepts which you should know. Hedged item. Hedged item is the item on which you are running the hedged instrument, which in other words is a derivative. So your hedged item is an asset. It could be an asset, it could be a liability, it could be a firm commitment, it could be highly probable forecast transaction that exposes the company to risk. So on this you apply this, which is your derivative. And what is a derivative? It is your hedged instrument made up of such as forward contract, option, swaps, and these are used to offset the risk associated with the hedged item. Now, when we talk about the hedge effectiveness, now remember one thing, your hedged item has to go this direction and your hedged instrument has to go this direction for it to be effective, isn't it? Because you were assuming that's what's going to happen. So for you to protect yourself from this happening in the future, that's why you got into this. So this is your hedged instrument and this is your hedged, I would say, item. So that's item and this is your instrument. So hedge effectiveness, the extent to which changes in the fair value or cash flows of the hedging instrument offset changes in the fair value or cash flows of the hedged item. And the hedge accounting is only permitted if hedge is expected to be highly effective. Then you've got the designation formally identifying the hedging relationship, including the hedged item and the hedging instrument and the nature of the risk being hedged. Documentation is to prove that you can use the hedge accounting, like preparing, maintaining the documentation that outlines the hedging strategy, the relationship between the hedged item and the hedging instrument. As you can see in here, your hedging concepts in accounting. Okay, so If you talk about the documentation, which will outline the strategy, if we look at the designation, it identifies the hedging relationship. Hedge item is the risk itself. Hedging instrument is the savior, which is a derivative itself. And then you ensure the risk offset, which is your hedge effectiveness. Now, you will in the exam encounter two types of hedges. All right, okay, and that also comes under the IFRS 9, which is your financial instruments. Cash flow hedge, fair value hedge. What is cash flow hedge? Simple and easy. The cash flow hedge is that you are trying to safeguard your cash flows, which is associated with a particular risk. And of course, that is related to your asset or liability, or a highly probable forecast transaction and could affect the P&L. So cash flow is to do with the cash. Fair value hedge is to do with the fair value of, let's suppose, an asset or liability or any unrecognized firm commitment. Firm commitment simply means is when you're committed to getting a supply because of the nature of your business. So let's suppose if you are an airliner, your biggest expense is fuel. You need fuel in order to run the airline. So you've got a firm commitment with the supplier that you will keep on buying fuel from them for you to operate in the business. So in terms of the diagram comparing cash flow and fair value hedges, so in terms of the cash flow, variability in the cash flows, forecast transactions, so you will apply cash flow hedge. In terms of the changes in fair value, firm commitment, you apply the fair value hedge. Now, let's look into the cash flow hedge in a detail. So a cash flow hedge is used to protect against the risk of fluctuating future cash flows. For example, a company might use a cash flow hedge to protect against the risk that the price of a commodity they expect to purchase in the future will increase. Or a company might use a cash flow hedge to protect against the risk that future revenue in a foreign currency will decrease in value due to exchange rate fluctuations. So, in simple terms, you're going to use the cash flow hedge when there is directly cash involved due to foreign currency fluctuation. Okay, maybe there is something to do with the commodity price and things like that. So if you are in a position where you're purchasing the commodity, if the prices go against you, you will get into the cash flow hedge. As you can see in here, there's some pros and cons for the cash flow hedge. It protects against the price increases if you are a buyer, if you're purchasing. It stabilizes the revenue and it reduces uncertainty. Okay, this is what we need. But what are the issues, the problems? It can be complex. Potentially, it can create a loss for you. The cost of the hedging can be steep. Now, let's suppose if you take an example, a UK company expects to purchase raw materials from US in 3 months' time. What they're worried is that the exchange rate will move against them, increasing the cost of the raw materials. So what they will do, in order to hedge this risk, they enter into the forward contract to buy USD at a fixed exchange rate in 3 months' time. So technically they will get into a type of a forward contract. A forward contract. They will get into a forward contract. Now, as you can see, there's a timeline from here to here. So the first thing is you have identified the currency risk. So the company recognizes the potential exchange rate fluctuations. Then they get into a derivative. In this case, they have selected forward contract. They fix the exchange rate. So when they get into the forward contract, they're actually fixing this. So they have no exposure to any big fluctuations. Then they purchase a raw material and they mitigate the cost increase. If the cost goes up, then the fixed exchange rate would kick in and help them in order to minimize any cost increase. Now, when we talk of the hedging instrument, changes in the fair value of the hedging instrument, the forward contract are recognized in other comprehensive income, in the cash flow, hedge reserve within the equity to the extent that the hedge is effective. Now, this is very important. Effective goes into the OCI. The hedged item itself, the hedge item, the forecast purchase of raw material is not initially affected because you have not acted on it, because that's going to happen in 3 months' time. If we take example as we just saw previously. Now, when the forecast transaction occurs, when the raw materials are purchased, the amounts previously recognized in OCI are reclassified from equity to P&L in the same period during which the hedge forecast transaction affects the P&L, when the raw materials are used in production and the cost of goods sold, because then the unrealized becomes realized. And then any ineffectiveness will go straight into the P&L. So any ineffective portion of the hedge, that is the portion of the change in the fair value of the hedging instrument that does not offset the change in expected cash flows of the hedge item, is recognized immediately in the P&L. So there are 4 things: hedged instrument, item, transaction, when it occurs, whatever happens in between, and any ineffectiveness goes into the P&L. As you can see in here, your cash flow hedge accounting, you identify the hedge instrument, you recognize the change in fair value, hedged item remains unaffected, forecast transaction occurs, the raw materials are purchased when planned, reclassify the OCI, it goes into the P&L because now it has been realized because you have bought the raw material and recognize the ineffectiveness. So if you follow this religiously, these 6 steps, you will never ever go wrong. So once again, the step number 1 is to identify hedging instrument, recognize any fair value changes. Number 3 is hedged item remains unaffected. 4 is your forecast transaction occurs, reclassify. 5 is your reclassify OCI to P&L, and 6 is to recognize ineffectiveness. So, well, in simple terms, the gains or losses on the hedging instrument are initially parked in equity and then released to the P&L when the hedge transaction impacts the P&L, when it gets realized. Job done. If you talk about the fair value hedge, what it is, a fair value hedge is used to protect against the risk of changes in the fair value of an asset or liability. For example, a company might use a fair value hedge to protect against the risk that the value of the fixed rate bond, in this case a liability, will decrease if interest rates rise. So, as you can see in here, fair value hedge structure, market. So the first one is a fair value hedge, core strategy of asset liability protection. Okay, that's exactly what you need to do. Yeah. And then you have the risk of fair value changes. So risk of the fair value changes in here, as you can see. So risk of the fair value changes. Number 3 is your asset liability financial item subject to market fluctuations and market condition, external factors influencing fair value. Yeah, so these are the 4 things. This is the fair value hedge structure. Yeah. So let's see an example. A company has issued a fixed rate bond. They're concerned that rising interest rates will decrease the fair value of the bond. To hedge this risk, they enter into an interest rate swap where they receive fixed interest payments and pay variable interest payments. Now, in this case, as you can see, the risk of decreasing value, protection against changes. So what you'll do is, the hedge instrument, the changes in the fair value of the hedged instrument, the interest rate swap are recognized into the P&L. The carrying amount of the hedge item, the bond, is adjusted for changes in the fair value attributable to the hedged risk. These changes are also recognized into the P&L, and any ineffective portion of the hedge is reflected in P&L as the changes in fair value of both the hedging instrument and the hedged item are recognized there. So nothing goes into the OCI, as you saw in cash flow hedge. Nothing goes into the OCI when it comes to this. Again, if you look at a timeline, you identify the hedged instrument, you recognize the interest rate swap as the hedging tool, you recognize the change in fair value, record changes in the swap's fair value in P&L. Hedged item, modify the bonds carrying amount based on the fair value, and recognize the changes in the hedged item, identify any ineffectiveness, and reflect ineffectiveness in the P&L. So 1, 2, 3, 4, 5, 6 steps in here. Once again, in simple terms, both the hedging instrument and the hedged item are revalued to fair value, and the gains or losses are recognized into the P&L. This offsets the impact of the hedged risk on the company's reported earnings. Finally, as you can see, what's the key differences? Summarized between the cash flow hedge and the fair value hedge. Cash flow hedge is to protect cash flow risk, and the fair value hedge is to mitigate fair value risk. I hope this video was very useful. If you have any comments, please comment below, and hopefully I will see you in the next video. Good luck.